When that happens, when there's a crisis, when there's a flight to safety, the contrarian investor, provided that he or she has done sufficient research in the market that they're considering, when everybody flees a market, that's precisely the time you go in. It's easy to say, it's tough to do. I believe for most people, yourself and myself included, that the United States market is the best place to be, provided equality of opportunity, which is to say, if you had a US company that exhibited the same price to value characteristics as a Brazilian company, you would prefer to be in the United States because the United States has much more developed capital markets. It has still much more rule of law. It has a much, much, much larger capital pool. It is easier to build a big company in the United States than it is in Brazil. If, on the other hand, like me, you're a natural resource investor and speculator, and you see a small company that's made a large nickel discovery in Brazil, and you see that that discovery is better than anything that exists in the United States, sometimes you have to take that political risk. Sometimes you have to take yourself into a culture that you know less about and is also arguably riskier because the opportunity is so much greater. If you're going to make a thematic move into frontier and emerging markets, I think you need to do it in times of crisis. I used to, this is in the 80s, I used to occasionally trade the bellwether Mexican stock, which was Teléfonos de México, the national telephone company there. And what you could do in the 80s is anytime there was a political shock in Mexico, and that used to happen sort of every 3 months, the Mexican stocks would sell off and you could buy Teléfonos de México. And as the world forgot about what had scared them, the price would go up and you could sell it. I remember very well when the Mexican presidential candidate, Colosio, got assassinated in Tijuana. The Mexican stock market fell overnight by 35 or 40% and kept falling. It wasn't 3 months later that the world was looking at growth rates in Mexico and couldn't even remember how to spell Colosio. But in order to participate in that trade, you had to have the courage to buy those stocks when a presidential candidate got assassinated in public. I'm not saying, by the way, to buy a market that somebody needs to be assassinated. What I'm trying to say is that you buy risky markets when the risk is highest, or the perception of the risk is highest. I believe in the very near term that rising US interest rates are going to continue to hurt the gold price. I'm surprised actually that the gold price isn't a little lower. The gold stocks, if you look at the net present value of their free cash flows relative to their enterprise values at today's gold price, are probably the cheapest I've ever seen them. Very, very high quality companies like Barrick or Newmont paying 5% dividends and paying 5% dividends while still investing substantial amounts of free cash flow in sustaining capital and new project investments is truly spectacular. I think that you're going to need to wait a little while because I think thus far the Fed has been successful and will continue to be successful in raising interest rates. If the increasing interest rates that we're seeing have the effect, which is to say, making new homes unaffordable and ending, if you will, home construction, making consumer durable purchases like automobiles less affordable, making the interest charges on the debt to federal, state, and local governments unaffordable, meaning if, as, and when the Fed has to back off allowing interest rates to rise, then I think you'll see gold go crazy. If the Fed blinks, I think you'll see gold go absolutely crazy. You got it. I mean, gold does well during periods of time when investors and savers are worried about the real returns, the inflation-adjusted returns on other classes of saving assets. Right now, people are less concerned. They're seeing deposit interest rates rise. So somebody who goes to a bank who used to be getting 0.5% is now getting 1.2%. He or she feels a little better about that than they did before. If they look at that 1.2% against the destruction of the purchasing power of their currency, which is to say 9% inflation, they're going to feel less good about it. But that takes some time. What you see is that interest in gold tends to vary inversely with the direction of U.S. interest rates. But historically, yes. As an example, if you were to talk to somebody of my age who was Vietnamese, who came here as a boat person, they'll tell you that the way that they were able to get out of Vietnam was not officially, was because they had gold. If you talk to somebody a generation older than me who is Jewish, who managed to get themselves out of Europe, it wasn't because they had a polysyllabic last name. It was because they had gold. So gold has done well during periods of crisis because it's a universally recognized store of value, and it's relatively valuable given the size that's required to complete a transaction. What's interesting about the history you study is that for some reason, gold was recognized as a store of value, as a medium of exchange, and also as an item of beauty for religious iconography and jewelry in every developed culture in the world. Gold was popular in the central part of South Africa, in what is now Zimbabwe. Gold was popular in Northwest Africa, in what is now Ghana and Nigeria. Gold ran the Arab world. The Europeans coveted gold. The Chinese coveted gold. The Indians coveted gold. And in this hemisphere, cultures like the Mayas and the Incas also coveted gold. It's interesting that cultures that ostensibly had no connection with each other, at least no proven connection with each other, or very undeveloped connections with each other, all developed the same reverence for the beauty and malleability of gold, and all regarded it both as a medium of exchange and a store of value. I think that's very important. I own a reasonable amount of gold, more gold than I probably need to, given my shareholdings in Sprott, which will do well if the gold price increases. But I own gold as an insurance policy. It's odd that I own a lot, and I kind of hope the price doesn't go up, because the set of circumstances that makes the gold price go up is problematic for the rest of my lifestyle. And I enjoy my lifestyle just as it is. I would like nothing better than to shed my mortal coil a long time from now and look back and say, you know what, those gold holdings were a mistake. The world just got better and better and better. I don't think that's what's going to happen. And I got to say that one thing that gold does do is it allows me to sleep nights and stay calm. And having a gold insurance policy allows me to be more aggressive with other parts of my portfolio and more aggressive with other parts of my life, knowing that if worse came to worse, I'm likely safe as a consequence of my gold.